There's a reason the market feels so loud right now, and it has very little to do with what's actually happening beneath the surface. Price is unstable, key levels are breaking, and suddenly everyone has absolute certainty. XRP is going to $10. No, it's crashing below $1. No, it's headed to 50 cents. Every scroll delivers a new prediction with total confidence. And that alone should tell you something important. This is not a rational market, it's an emotional one. Markets don't move based on how fearful people feel on a random day. They move based on positioning, liquidity, and structure. Fear is loud, but it's rarely predictive. In fact, fear usually peaks when clarity is lowest, not when fundamentals are weakest. That's why narratives flip so violently. One week, XRP is dead. The next week, it's entering price discovery. Same asset, same system, completely different emotions. This is where most retail investors get trapped. They anchor their beliefs to short-term price movement, then build a story to justify it. When price drops, they search for reasons it must go lower. When it bounces, they suddenly remember every bullish catalyst. But narratives don't drive the market. The market drives the narrative. And if you don't understand that, you'll always feel like you're chasing price instead of understanding it. Right now, the strongest signal isn't a chart pattern, it's sentiment compression, extreme fear, extreme confidence, extreme certainty about outcomes that haven't happened yet. That's not clarity, that's confusion. And confusion is exactly where weak hands get shaken out while stronger participants quietly reposition. Another common mistake is assuming that losing support automatically means collapse. That's a short-term trader's framework, not a system-level one. Support levels matter for immediate flows, but they don't tell you whether the underlying structure has actually changed. If you're judging an asset like XRP through a 3-day chart, you're missing the bigger picture entirely. XRP was never designed to be validated by retail sentiment cycles. It was designed to operate independently of them, and this is also why fear-based content spreads so easily. The crash is coming. This is going much lower. You don't want to be holding when this breaks. Those messages spread because they align with how people already feel. They don't require understanding. They simply amplify anxiety. And the irony is, the same voices flip bullish the moment price rebounds and claim they called it all along. That's not analysis. That's emotional reflection. If you step back and look objectively, nothing structurally meaningful has changed just because price is under pressure. Markets pull back, liquidity tightens, confidence fades. That's how cycles work. The real question isn't where price goes tomorrow. The real question is whether the role this asset is building toward has been invalidated. Fear-driven posts don't answer that. This is why confusing catalysts with immediacy is so dangerous. ETFs, regulation, institutions, partnerships, people talk about them like they flip a switch overnight. They don't. These factors change the direction of the system, not the speed of price. Expecting instant gratification from long-term structural developments is how people burn out, sell at the wrong time, and later convince themselves the market was rigged. So no, this isn't about calling a bottom, and it's not about pretending downside risk doesn't exist. Markets can always go lower than expected, but it's also not about surrendering to fear just because it's popular. Markets don't reward emotion. They reward positioning relative to structure. Before talking about partnerships, institutions, or adoption, one thing has to be clear. Price noise is not the same thing as structural failure. And right now, most people are reacting to noise. What usually happens next is predictable. People line up catalysts, ETFs, regulation, institutional money. The logic sounds clean. If everything is bullish, price should move soon. And when it doesn't, frustration sets in. That frustration is not a market signal. It's a misunderstanding of how markets actually work. Here's the uncomfortable truth. Catalysts don't move price by themselves. They create permission, not momentum. They change what can happen, not what must happen immediately. Retail investors confuse those two things constantly. That's why they stay out of sync with institutions. Institutions don't see an ETF approval and rush in the next morning. They reassess risk models, update compliance rules, study liquidity, and wait to see if the structure can absorb capital without distortion. That process takes time, and it happens quietly. By the time price reflects it, positioning is already done. That's why the everything is lining up narrative is misleading. Alignment doesn't equal ignition. Markets move when multiple constraints are removed at the same time: regulatory, liquidity, custody, risk, and timing. Miss even one, and price stalls, no matter how bullish the story sounds. Another misconception is assuming institutions behave like leveraged traders. They don't. They're not chasing upside, they're managing downside. When institutions evaluate XRP, the first question isn't how high can this go? It's what happens if this breaks? If that question doesn't have a clear answer, capital stays sidelined. This explains the constant narrative whiplash around XRP. One week, institutions are coming, the next week, nothing is happening. In reality, institutions are doing what they always do: moving slowly, deliberately, and only when frameworks are ready. Silence isn't inactivity, it's due diligence. The ETF conversation is a perfect example. An ETF doesn't create demand, it creates access. Access matters, but access without conviction doesn't move markets. Conviction comes from clarity, liquidity, depth, and confidence that price behavior won't introduce portfolio risk. That takes time, especially for an asset designed to operate at a system level, not as a speculative trade. Regulation works the same way. Regulatory clarity doesn't trigger instant buying. It removes enforcement risk, allowing institutions to even consider participation. That's progress, but it's one step, not the finish line. This is why people get discouraged right before real transitions begin. Foundations are built quietly. The visible structure comes later. Markets don't announce when they shift from preparation to execution. They just move. If you understand this, you stop reacting emotionally to headlines. You stop counting catalysts like lottery tickets, and you stop assuming delay equals failure. Instead, you watch whether the barriers preventing capital from entering are being removed, one by one. From here, the real tension becomes clear. Ripple can execute well as a company, while XRP remains difficult to underwrite for some investors. That hesitation doesn't signal failure. It signals how early this market still is. Infrastructure assets aren't built around short-term appreciation. They're built around adoption, liquidity depth, and system integration, things that don't show up cleanly on charts. Infrastructure assets don't need universal belief. They need functional demand, demand that appears quietly until it doesn't. The real question isn't why everyone hasn't bought XRP yet. The real question is what conditions would make XRP non-optional. Because when an asset becomes necessary, adoption doesn't require belief, it requires compliance. That's the transition most people aren't prepared for. And that's why emotional decision-making is the biggest risk here. Fear pushes people out too early. Certainty blinds them to risk. Calm, continuous evaluation is the only sustainable approach. Narratives change fast, systems change slowly, and the people who navigate transitions well aren't the loudest. They're the ones who stayed focused while the work was still boring. I'll see you in the next one.